Andrew, are you a bit disappointed with the budget? The fact that Union Budget 2013 has done precious little to stroke the investment cycle and to kickstart the general economic cycle?
Yeah, I think I am actually. I mean, it was kind of not too hot, not too cold, but certainly not right. To kind of glean any kind of growth hopes, from what the finance minister delivered. Maybe our expectations were too high. Certainly, before the budget, watching your channels, many commentators were, I think, expecting a little bit too much, and you just get disappointed when that doesn't happen. Sadly, now we kind of go into what's happening globally, and the fear is, given what's happening in the US, there's a property rate hike or capital gains tax in China, and there's the ongoing problems in Italy. If there's a risk-off trade, then obviously the risk for India is that FIIs might start to do some selling, and that will be mainly the large caps, which will take the most of that heat, and therefore that's probably why we're seeing the markets come down. And that would exacerbate itself in many ways in terms of our thoughts would quickly go towards the currency and then the current account deficit. So very short term, it's the negatives are certainly outweighing the positives, because unless now the finance minister or the government start to introduce a slew of new reforms to keep the momentum going, then really we're not looking at a great prospect. And earnings growth, although they've been hit by obviously the surcharge on corporate tax. So we could see some more downgrades coming, and I don't think that's what the market was hoping for or expecting when we came into 2013.
So Andrew, would that also entail then significant amount of outflows from this juncture? And what we've seen in the last few days, a 2.5% cut coming in for the index. Could this just be the start of it all, and there's further weakness in store?
Yeah, I think very short term. I mean, I said that global cues will probably be at the forefront for us. And unfortunately, they're not looking supportive right at this minute. So, we could see that risk-off trade, and it doesn't take much for markets to move down these days. So I'm not saying we're going to see huge amounts of selling. Maybe $1 to $2 billion of FII outflows could happen, but that will be enough to send the market down another, 2-3% from here, before we see any real value. But it's not. I don't want to sound too negative. This is more of a short-term call, but I think in the next for the next kind of month of March, it's going to be a little bit more volatile than we'd seen in the back end of the year and how we were looking coming into 2013.
The mid-cap space is not looking shaky, but it is looking extremely shaky. I mean, the mid and the small-cap space has got derated significantly.
Yeah, it's just been horrible. It's difficult to comment on some of the stocks you mentioned because you don't know the reasons really behind the big falls. Let's hope SEBI's inquiry throws some light on that. Because some of these stocks have, you feel that there's value, but you're just not sure why the share price has fallen so significantly. So, fortunately we kept to the large caps and, been very, very selective, as we always are in our mid-cap selections. But I think this remains the kind of warning for getting too excited about markets and then dipping below the large caps to try and get extra alpha, and sometimes it's just very painful, very, very painful.
Increasingly, one has been seeing that IT and defensives, that is pharma, are the ones which have been outperforming. Do you think this trend is here to stay?
Yeah, it's something that we kept with. If you remember when we last spoke, I said I was keeping to the defensive side of the portfolio. Wasn't really kind of buying the long term kind of story of buying across the board interest rate sensitives and high beta stocks. I said that I'd like to rent them rather than own them in any market rise, and that's paid off well for us. So our portfolio is still geared towards the defensives, whether that be consumer, IT, or pharma, and we've added more of the oil companies as well in the past few days on the back of what the government's saying about the subsidies going forward. So we feel that could be a beneficiary for the likes of ONGC and Reliance going forward. So those are the stocks which we've been adding and increasing our weightage. But again, we're starting to look again at the interest rate sensitives, the capital goods sectors, because the government has to throw money into the economy at some stage, and we think that's going to be the first quarter of 2013-14. So let's not give up hope too much. But I think, as I said before, I think March is going to be a little bit more volatile and tricky than we've been used to for the last 6 months, and therefore the market's not really been ready for that. So it could throw up some very good opportunities. So we're happy where we are in defences, but we're looking more actively at other sectors now again, where there's more value.
So at the current juncture, where do you think is the real base for this market? Do you think 5,400 will act as a base, or 5,500 will act as a base, or 5,600 could act as a base?
I think around 5,500 will act as a base, because I think at that level we're looking at PE valuations again falling into the attractive zone on a kind of a longer term basis, and I think that's where FIIs will say, okay, we can start picking up some good value again. I think the problem at the moment is how patient FIIs might be, given that they have put in some nearly 8.5 billion so far this year and really not seen a great return from that, or with the currency. So they might sit on their hands a little bit more, weigh up what the global risks are, given what's happening in the US and Europe, and maybe the allocations towards India, kind of go more towards China in the short term, where growth is seen to be much higher, valuations cheaper, and the government there starting to take some action to, one, cool the property market, but also grow the domestic economy, and they obviously have a better balance sheet to do that than India does at this time.
Bond yields are once again marching towards 8%, and the fact that bond yields are headed higher, in the near term, do you expect PSU banks to underperform? I mean, that trade seems to be reversing. When we started the year, bond yields came down, PSU banks, they went up, but now that trade has reversed.
Yeah, it's obviously the government's going to do a lot of borrowing in the first half of the new fiscal, and that's what's being reflected by the bond yields. So not surprising there. The bad thing is for the equity markets is that you have a good alternative for your money, which can be safer than the markets in the very short term. So again, that kind of switch from bonds to equities might take a little bit longer than we were hoping for when we came into the year. But that would, we'd study. I would say that's the part of the reasons we're looking at some of these interest rate sensitives like the PSU banks a little bit more closely. Value starting to come back after the big run up we saw at the back end of 2012 and 13 when we first came into the first few months. So, I said I'm not trying to be too negative. I think short term we've got some headwinds which are more global. I don't think we've done ourselves any favours in terms of being able to go out there and project a great earnings growth story for India. I think anything between 10 to 15% earnings growth is probably the range at the moment. Whereas I would have said a few weeks back that it was more like 15% because of some of the things that the government were doing. I think that's under challenge at the moment, and I think that's going to worry markets and investors, because, as I said, I don't think we're expecting earnings to be downgraded so early going into the new fiscal.
Andrew, good chatting with you, and appreciate you taking the time out and joining us.